Good afternoon and welcome back to another edition of NCIA's Industry Essentials Educational Webinar Series. I'm Brian Gilbert and I'm thrilled to kick off another episode of NCIA's Service Solutions Series today, being presented by ERT Credit. For those tuning in for the first time, NCIA's Service Solutions is our sponsored content webinar program, which allows business owners the opportunity to learn more about premier products, services, and industry solutions directly from our network of established suppliers, providers, and thought leaders. Well, think your cannabis business does not qualify for COVID-19 relief funds? Well, in today's program, the experts from ERT Credit are here to clear up the confusion for an exclusive webinar outlining how cannabis businesses can take advantage of the Employee Tax Credit, or ERC. In case you're unaware, the ERC has currently only been claimed by a small fraction of cannabis businesses, and most importantly, as a payroll tax credit, is not subject to the provisions of Section 280E and can be worth up to $26,000 per employee. You'll leave today's session with a roadmap for next steps to take advantage of this opportunity so you don't miss out on a guaranteed refund worth hundreds of thousands of dollars and in some cases millions. But as I mentioned during the open networking period, don't forget this is an interactive experience, so don't hesitate to post those questions throughout the hour, and our panel will address during a dedicated Q&A period after the primary presentation concludes. All right, enough with the intro. To kick things off, I'd like to welcome our panel for today's program, being moderated by Kash Badami, Chief Operating Officer at ERT Credit. You can activate your video feed and join us here up on the virtual stage. Welcome to NCIA's Industry Essentials. Great to have you and the ERT Credit team here. I think before we kick things off today, you're going to lead the panel in a brief introduction so that everybody knows about their background and expertise and experience with the industry and the ERT Credit. So from there, I'll deactivate my screen share and you can kick it off right from here, Kash.
Awesome. Thank you so much for that great intro, Brian. Welcome, everybody. Thank you so much for joining us. With me are Liz Hafner and Jordan Anderson. Jordan actually is one of the leading, if not the leading experts on the ERC. Jordan's done this credit for over 1,000+ businesses over the last year and a half or 2 years, I would say. And what's really interesting is he pioneered the ERC for 280E, or actually not 280, for the cannabis business, despite the effects of 280E. Jordan was one of the first folks to actually come up with the mechanics to apply this credit to the cannabis industry. So we're very fortunate to have him here. Also with me are Liz Hafner. Liz was one of our first customers. So Liz is used to be a restaurant owner, and frankly, to some extent, quite skeptical about this credit. And she's here because we think what we wanted to do was, in addition to bringing the expertise that Jordan brings to the table, we also wanted to combine that with some customer insights, especially around thoughts like, this is too good to be true, when will I get the money, things like that. Many questions that are going to come up for you all. Liz has actually been through that experience. So welcome, Liz and Jordan. I'll turn it over to Jordan real quick if I missed anything, and then Liz, we can do an intro for you as well, and then move forward.
Thanks, Kash. Appreciate that note. I want to say good morning or good afternoon, depending on where you're currently at, just to kind of piggyback on some of the thoughts that Kash said, a little bit about my background. So I run an accounting firm. We do payroll for a few thousand restaurants, bars, hotels, nonprofits, law firms, you name it, cannabis industry across the country. And I've been in the space for about 12 years now. The employee retention credit, when it came to fruition during the pandemic, thought it was a no-brainer to get involved, not only because it's, a credit that clients are able to receive and obviously tap into, and in some cases, it rescues the enterprise altogether. But the credits are absolutely sizable, and if money is owed to you, then rightfully so, we're going to take it off the table and redirect it to your pocket. So, started with the employee retention credit back in March of 2020, right at the beginning of the pandemic, and we've been here ever since. And back during Hurricane Katrina, that's when the actual credit in itself actually materialized and, was signed into law. So we've had a little bit of exposure to it for quite some years now. So it was interesting when the pandemic, unfolded, that the ERC did make its way back to the forefront. So with that in mind, I will pass it over to Liz.
Hi, Liz Hafner, former restaurant owner and one of their first clients with ERT Credit. And yeah, we did my credit in November of last year, and I got my checks from the IRS this last April. And even though we sold and closed the restaurant, it's still really helpful to close out that business, etc. And like Cash said, I was skeptical because dealing with the IRS is generally can be a little difficult. And they've helped me every step of the way from the beginning to getting my checks, and then still some questions with the IRS and working with my accountant and making sure everything is done correctly. And yeah, super grateful for the over $200,000 they got me.
Well, thank you, Liz. Okay, with that, I have our quick presentation up. Just to give the audience a feel for this, as Brian noted, this is a interactive discussion. This is really about you and making sure that you understand and at least get answers to any questions that are generated or you already have coming into this. So please ask those questions. We're here to help. We want this to be a very educational experience for you. And with that, I'm going to turn it over to Jordan.
Absolutely. Thank you, Cash. Okay, so for today's agenda, just to run you through everything briefly. So we started off with our intro. We will discuss what the employee retention tax credit is, provide a brief history, talk about some of the challenges surrounding the ERC. There's a lot of technicalities, misinformation that's been spread over the years, and many folks working on outdated guidelines and things of that nature. So we'll run through those challenges. We'll talk about the differences between ERC and PPP, just because, again, there's a lot of misinformation surrounding those two tidbits. For our cannabis folks, PPP wasn't even in the realm, so that should not be an issue for the vast majority of you, unless you had maybe a business that pertains to cannabis, but not necessarily, producing, for example, right? So there may be some PPP interplay, and then we'll end it with a Q&A. Any questions, concerns, comments that you'd like to add, happy to answer. And, our goal today is to make sure that you leave not only educated, but with all your questions answered. So what is the employee retention credit? So as I talked about briefly moments ago, the employee retention credit, it is a tax credit that came to fruition during the pandemic in the early stages back in March of 2020, a very sizable credit. Now, contrary to popular belief, the employee retention credit is not a traditional tax credit, okay? So this isn't you have tax liability of $100,000, you have a credit for $100,000 and it wipes it out. That's not how it works. So the tax credit is actually a cash refund directly from the IRS, okay? So you will receive live checks for each given quarter, granted that you're eligible for that particular quarter or the quarters in question, okay? When you get the checks, obviously they're cashed as any other check right to the bank, and that's all she wrote. In terms of the credit itself, let's talk a little bit about what it is from a high level, and then get into the mechanics a little bit, right? So the credit in itself for 2020, it's worth up to $5,000 per individual for the year, okay? And how you work that out is you're able to get a 50% credit on the first $10,000 in wages per employee for the year, hence the $5,000 maximum. For 2021, that credit is actually beefed up from 50% to 70%, and it is on a per quarter basis instead of for the year, right? So all that means is $10,000 per quarter, quarters 1, 2, and maybe 3, depending on where you're located at, because there's different eligibility criteria which we'll dive into. So $7,000 per quarter, 21 grand. All in all, you add 2020 and 2021 together, you're looking at up to $26,000 per employee. So definitely a significant amount, and something that, is to many folks just quite mind-blowing, especially how big your enterprise is, right? It's not uncommon, and actually the average credit we see is a little bit over $100,000. So you're talking a six-figure credit, and the money is on the table right now. Granted, you're eligible, we just need to remove it, right? And then of course we've seen credits that balloon into seven figures, low seven figures, $2, $3, $4, $5 million, which we've seen verified, validated, computed, the full 9 yards, and these folks have been paid, right? So that's the employee retention credit in a nutshell in terms of the value. So let's talk a little bit about the history of the ERC. So March of 2020, ERC and PPP was brought to life by Congress. At that point, okay, this is very key. At that point, the business in question could only get the retention tax credit or the PPP loan, or loans rather. If you received the PPP loan, you cannot get the ERC. If you received the ERC, you cannot get the PPP, right? Fast forward to November of 2020, and many businesses are focusing on the PPP, also known as the Paycheck Protection Program. Again, my cannabis folks that have dispensaries and whatnot that were not eligible for the PPP loan, that obviously wouldn't phase you at this point. And back during that particular time, again, PPP was the one being pushed. The retention tax credit was just on the back burner. Or what we've seen is a lot of CPAs, accountants, financial advisors, so on and so forth. They were working on outdated guidelines and pretty much told their client or clients that they don't qualify. And they didn't do this in bad faith, but again, there was a lot of changes and whatnot happening at the IRS, which leads me to December of 2020. IRS changed the rules as it pertains to the PPP and the ERC, the retention tax credit. And beginning of January 2021, folks were able to retroactively go back and actually claim the retention tax credit, even if they received the PPP loan. Okay, so just to piggyback on that point, most businesses are not aware of the retention tax credit, and or when their accountants told them that they didn't qualify, they didn't even put it on the back burner. They totally flushed it from their mind, and that was all she wrote, right? February of 2022, so several months ago, at that point in time, only 12% of businesses that were eligible for the credit actually claimed it. So there's tens of billions of dollars out there that's effectively sitting on the table that folks simply need to claim. There's an IRS call every month, and that number is still hovering at around right below 20% in terms of total businesses that are, again, eligible to claim the credit, but have yet claimed it. So let's talk about eligibility, okay? So 3 different ways to qualify for the credit. First and foremost, the easiest route of qualifying for it. And before I dive into this, the 3 particular ways that I'm going to discuss today, they're mutually exclusive from one another. So you do not need to hit, 2 of 3 criteria, all 3. You just need to hit one of them, okay? Very important. So step 1, or way to qualify, the first way, is a reduction in gross receipts. Okay, so for 2020, you would be looking for a 50% reduction in gross receipts for a particular quarter in comparison to the same quarter in 2019. All that means is, say, for example, you're looking at a profit and loss statement, or a income statement, balance statement, whatever the case may be, anything that shows your total gross sales for quarter 2 of 2019, and you're comparing that same quarter to quarter 2 of 2020. If in 2020 you have a 50% decline in gross revenue or gross receipts, gross sales, they're all synonymous with one another, then you're eligible for that quarter in question, and you're immediately, or the subsequent quarter is automatically eligible as well, okay? For 2021, the government kind of eased the restrictions in terms of, the criteria that you need to meet, and instead of it being 50%, they wanted to see a 20% decrease in gross revenue. So again, we would look at quarter 1 of 2021, the P&L, or the gross sales, and compare that quarter to quarter 1 of 2019. If you had that 20% decline in gross revenue, then you would be eligible for quarter 1 of 2021. Okay, so the gross receipts test, relatively easy to take a look at, analyze, make sure everything is good to go, and you can obviously substantiate that, hey, we were able to produce eligibility because X, Y, and Z, right? So fairly easy way, and the foremost way that we're always looking at first before anything else. Okay. Qualifying criteria number two, or another way to qualify, which again has proved to be extremely fruitful for our restaurant bar clients, and then mainly as well cannabis. Okay, because our folks that have retail, a dispensary, they had to reduce their capacity, right? So this is for all dispensaries really across the United States that suffered from capacity restrictions. The question is, from X date until Y date, we had to reduce capacity. So state to state is a little bit different, but there's money on the table for at least all of our dispensary folks that do have a retail front that's consumer facing, right? You have patrons come in on a daily basis, weekly, whatever the case may be. We'd be able to get eligibility based on reducing your capacity. So for example, in California, beginning on March 19th of 2020, all the way through June 14th of 2021, for the most part, depending on the county that you were in, you had to reduce your capacity. There's certain tiers, only 25% at one point from, X month to Y month. And then it got eased a little bit and they increased it to 50%, right? So we had the capacity restriction. And then on top of that, you may have been forced to operate for takeout only, right? So again, that's why I like to kind of bring restaurants into the mix. There's a lot of similarity there in terms of what you had to do. So takeout only, or curbside for the dispensaries, right? No one allowed inside the building. So there's a bunch of mandates and restrictions that you had to adhere to in order to obviously continue on with your business, right? Obviously, nowadays things have calmed down a lot, which is absolutely phenomenal. However, back during the peak of COVID, if you will, where all the mandates were kind of locked and loaded and you had to adhere to them or you'd be subsequently fined, right? There was quite a few things that you had to do, many headaches, I'm sure, blood, sweat, and tears, as I talked to many folks, and, you were forced to pivot on, in some cases, a daily basis, right? So again, just to recap for number two, you're looking at a capacity restriction. So any kind of partial or full disruption or suspension of your enterprise as it pertains to capacity, or more specifically, number of individuals allowed in the building. In terms of your consumers, that's what we're looking for to get you that eligibility. Okay. And then qualifying criteria number three, and this is going to be for my folks in the cannabis industry that are more so on the manufacturing side and perhaps don't have a dispensary, right? Or anything that's retail facing, if you will. So we'd be looking for, again, a supply chain disruption. What I mean by this is, so we had a client that has several dispensaries, and they also have some manufacturing companies that actually did the processing of the material, right? So these particular companies were separated, didn't fall into a control group, so they were a standalone company in terms of the processing. So we looked and seen exactly what took place for this particular enterprise. We looked at the profit and loss statements. We're trying to dive into if there was a dip in sales, which there was, but nothing that would bring them to the eligibility that we needed to see, right? So that was kind of a curveball, but by looking at these P&Ls, we're able to kind of pinpoint what months or quarters rather, did experience a dip, and then look into that particular quarter and see, hey, what happened, right? So in this case, this particular manufacturing company, and I think they process wax and distillate, basically, they were not able to source several pieces of equipment because their manufacturer, or their supplier rather, they were subjected to local and state mandates, so they were shut down. They had to reduce. They weren't able. Their output went to nothing. They cannot produce in this particular county. So by not being able to get a hold of their equipment, and then this supplier also produced them with I believe a bunch of labeling and packaging materials and things of that nature. And for their particular products, they weren't able to find a substitute. So that would be a supply chain disruption that would bring you eligibility. Obviously, things get a little bit hairy there, very gray. We stay out of gray areas altogether, but we're willing to hear, cases as it pertains to the supply chain disruption, and, we'll pick something apart. So if you have a couple ideas and you're not sure if that particular, disruption would qualify you for the credit, run it by us. We're happy to help kind of dissect it, see what's going on. And if we can draw a straight line to eligibility, we'll take it. We'll take that particular disruption and run with it as it pertains to the criteria surrounding the supply chain disruption. Okay. So credit maximization, this is another big one. There's a lot of factors and nuances that kind of come into the mix that make things a little bit difficult with maximizing the credit. One of the primary problems with the credit in itself, in terms of interplay, is the PPP loan. So quite painful to deal with, but many folks especially again in cannabis, never got a PPP loan, right? So in that particular case, you don't have to worry about that. But what we do see a lot in the cannabis industry is several enterprises or locations in one, right? So we may have 3 dispensaries, 2 processing plants, 2 management companies, and then a consulting company, right? So you got a lot going on. Depending on ownership, you have what's known as control groups and then standalone entities. Okay, so we're not going to really dive into this, but we'll discuss it a little bit in terms of control groups, just because I think it's important to this particular sector. So a control group is, for example, let's say you have 5 businesses, okay, all separate federal ID numbers. For 3 of the businesses, you have yourself and a partner, you guys own 50-50. On the other 2 businesses, there's several partners and, you know, everyone owns 10% or whatever the case may be, right? The 3 businesses that are you as well as a partner that own 50% each, those would be considered a control group or a singular employer, okay? The other 2 businesses would be standalone businesses. They may be a control group in their own right, but it would just be those 2 particular entities, okay? So control groups, again, in the cannabis industry, very popular. We see that a lot, and the reason for mentioning this is with control groups, there's a lot of technicalities and specific line items or variables rather that you need to really focus on and adhere to. So if you are a control group, all those locations that fall under the control group, they combine as a singular employer. So you wouldn't take credit for each given location. Depending on the employees. So if you had employees that worked at, you know, let's just say at all 5 stores, you had 20 employees at each that kind of went between all 5 stores or all 5 payrolls, right? All those employees would combine as a singular unit and their wages would combine. So again, you would just get a credit one time per employee versus at each and every given location, okay? Obviously very technical and just one example of many on how difficult maximizing the credit can be, okay? And then another tidbit that I just kind of want to touch on in terms of the credit maximization is, you know, being able to dial in on that eligibility on specific dates and really take every penny off the table when it comes to those wages that are qualified, right? Which is going to require a deep dive into local, state, federal mandates and, you know, really give a high level look at when were your operations actually shuttered, and when they were shuttered, when did they reopen, and then anything between, right, that, you know, we could have tapped into if you lost eligibility between those particular quarters, okay? So what about Internal Revenue Code 280E? This one has come up quite a bit. So 280E, it prevents cannabis businesses, any cannabis business really, from taking any kind of deductions and or credits against those income taxes that the company has, right? So, you know, we've seen this working with cannabis companies. We request P&Ls. Some folks don't even have P&Ls just because there's no kind of deductions that they can realistically take that would prove to be fruitful, right? The same thing is true for credits. However, there is a loophole in the IRC or Internal Revenue Code 280E, which, you know, dictates that payroll taxes, they don't fall within that particular IRC code. They are in a completely different section of the code, and it does not apply at all whatsoever to cannabis businesses when it comes to the retention tax credit, because the retention tax credit is not, as I hinted to earlier, that's why I brought this up, is not a traditional tax credit. It is a payroll tax refund. Those 2 line items are extremely different. They're on total different sides of the spectrum, which is why for cannabis businesses, this is an absolute home run. So don't let 280E scare you. There's many folks, many cannabis businesses, and there's actually been several reports about, you know, cannabis industries being absolutely ripe for the retention tax credit. Okay, so again, just to recap, 280E, not something that you should be scared of. You know, being in the cannabis world, it is most definitely something that is alarming, but rest assured that payroll taxes are a completely different section of the code. And as long as the ERC is a cash refund, which it is, and not a traditional tax credit, you're able to skirt the provisions that 280E dictates. So let's talk a little bit about the challenges surrounding the retention tax credit. So first and foremost, there's just a general lack of understanding of the credit, right? So again, just kind of piggybacking on original thoughts with the PPP loan, when many folks heard about the PPP, that's what they were all interested in. That's what the government was pushing. That's what the banks were pushing, right? And that's kind of a very important part. With the ERC, the banks were involved, okay? As we're all aware, banks are here to make money, right? They're going to do anything and everything in their power to make money, especially when you have something like this take place, something being COVID, where there's a government incentive. And, for the banks, this is something that they're able to not only underwrite, but really dive in and obviously collect their percentage off of this, right? The ERC was not something that they were able to do that for. So it only made sense for the banks and the government to push the PPP loans or Paycheck Protection Program, because the banks could administer that, have a more thorough control over it, and actually, I guess, dictate who qualified, who didn't qualify. And then in terms of the PPP loan forgiveness, same thing, it went through the bank, right? So there was a huge checks and balance reconciliation process that they had, and it only made sense for the PPP to be pushed, right? Having said this, that's kind of what swept the ERC, or the Employee Retention Tax Credit, under the rug. And then again, if you were told that, hey, you don't qualify, and you're told that by your CPA or accountant, chances are you're going to listen to them, right? You would think that they have, proper advice, everything has been vetted, and it's obviously up to date, right? Which leads me into my next point. So bad advice from trusted advisors, it was unfortunately a norm during the pandemic. And again, as I said earlier, this isn't that, they didn't have your best interest in mind, because they most definitely do. But with the guidelines changing at one point on a literal daily basis, it's easy to see how, there was a whole myriad of different advice circulating, and folks utilizing these guidelines that they may have been Googling or even looking on the IRS. And I can tell you directly from the IRS website, irs.gov, as it pertains to the employee retention credit and even the PPP, the IRS even wasn't staying current with what they were releasing in terms of new legislation, right? So you have, again, accountants, CPAs, financial advisors, business owners, folks like you and I that are just going on the IRS website looking for information, and it's not updated, it's not accurate. Eventually, the IRS kind of got things together, and the least that they can do, which they did, and it's actively out there now, on certain publications that are obviously outdated, they'll note that the particular publication is now outdated. Do not use that information. The information is still out there because it's archived, so obviously normal. But again, that's just kind of giving you a high-level overview of why there was that bad advice coming from trusted advisors, and many folks not being able to successfully navigate the waters. Okay. Fear. What if I don't get my money? This is a question almost every individual asks, which is a totally fair question, and I get it. We're dealing with the IRS, right? The IRS, many folks don't trust them. There's a lot of stuff going on at the IRS. They're using an outdated system. I could go on and on. Right now, they're hiring tens of thousands of individuals. That's a whole nother challenge in itself. And again, they're using a system that's been in place for decades, right? So the IRS was kind of jumbling with the retention tax credit and just general returns altogether, and trying to figure out what's going on, right? So anyways, the fear in itself, again, it's valid, but this is tried and tested. The retention tax credit has been out for a while. We've done this for north of 1,000 businesses across the country, and several different, actually dozens of different industries, from manufacturing, hospitality, so again, restaurants, bars, hotels, nonprofits, car washes, manufacturing companies, you name it. Cannabis, obviously huge. So this isn't a matter of if you're going to get paid, it's a matter of when you're going to get paid, right? So there's a very clear distinction there. As long as the process is followed, you have your computations, the returns are amended appropriately, they're sent to the IRS, and everything was adhered to in terms of the stipulations, and you have accurate computations and returns in file, you're going to get your money from the IRS. It's just a matter of when. Okay, so I would not let the fear get in the way, especially of an incentive like this. This incentive is for the business owners, right? So especially our cannabis folks here. In the cannabis industry, it never gets any kind of incentive. The federal government is out for the cannabis industry, if we're being honest, right? So this is one of the very rare times. I always like to refer, when I talk to a dispensary owner or anyone in the cannabis industry, that listen, this is your lottery ticket. This is your winning lottery ticket, to be frank. And it's a one-time opportunity, and something that folks should take advantage of, because it's money that you're rightfully owed. If your business was not impacted by the pandemic, and you were able to successfully pivot, You had no kind of interruptions. You had no capacity restrictions, no supply chain disruptions. You made money fine. That's awesome. Like, great, love it. But unfortunately, that wasn't the case for many people. Again, having to pivot on a daily, weekly, monthly basis, especially in the earlier days, adhering to local state mandates. Hey, you can only open from X to YZ times. For this month, or for several months during this particular period, you need to set a dedicated time for senior citizens to come in, which is totally fine. But just an example of one particular mandate that really disrupted, especially here in Michigan. There's a lot of dispensaries, and the government was stepping in and saying, hey, from X to YZ times, it had to be senior citizens. From A to B times, you could have it to the general public, and then back to C to D times, it had to be this particular group of individuals, right? So a lot of going back and forth, and the government telling you how to run your business. So again, this is an incentive for you. This is an incentive from the government, for effectively telling you how to run your business. So I would not be fearful of claiming a credit that's rightfully owed to you. Okay. Price gouging, there's a lot of that going on in the industry right now. There's a lot of fly-by-night companies, unfortunately, that are not accountants, CPAs, even financial advisors that are entering into the space just to realistically profit off the backs of people. It's unfortunate, but as with anything, when there's money like this, credits available, whether it be ERC, PPP, R&D credits, as I'm sure some of you have heard of, there's always someone there that's going to try to, weasel their way in when they shouldn't be there, right? And they're really doing a disservice to not only the industry, but the clients that are going to them, right? So I'd watch out for price gouging. When I say price gouging, there's folks that are charging 25, 30% of the credit, which is absolutely ridiculous. So just want to put that on the radar of everyone. Be careful. I would suggest, looking at that background, are they an accountant? Do they run a payroll company? Do they have an accounting company? Do they do full service accounting? What do they do, right? Just because, we typically see there's a lot of attorneys, for example, that are magically calculating this credit, or we even seen not even financial advisors, individuals from the tech space, for example, that kind of come in here and then they're trying to compute a tax credit. Okay, meanwhile they're a programmer, right? So you're going to have a programmer that is going to compute your tax credit for your business, and it's in many cases several $100,000. It just doesn't make sense, right? So be on the lookout for that. It's something that should be on everyone's radar. Okay, running out of time. There is a clock on the retention tax credit, so it's 3 years beginning or from first quarter of 2020. So we got a little bit of time. The credit in itself starts dying July of next year. So right around the corner, something again that should be on everyone's radar. Not something that you need to do tomorrow or perhaps even the next day, but definitely a credit that again you're going to want to take advantage of. Right? This isn't an incentive to where you're going to get $500 or even 10,000. Chances are you have 6 figures on the table waiting for you right now. So very important to take advantage of that while there's still time. Okay. And then lastly, for the challenges, and this is not, this is eased up over the, it's crazy to say, years. Wow, we're in the tail end of 2022 here. It's really eased up over the years. And so all this means is when the computations are prepared, everything is good to go, sent over to the IRS. Once they receive your 941, or actually I take that back. When your 941, your amended returns are sent in, to the IRS, general processing times were about 9 months. Okay, this was back kind of towards the earlier portion of 2021. Fast forward to 2022, we're looking at the sweet spot of between 3 and 4 months. That's been the general average, especially for folks that have credits that are under $200,000 per quarter. There's no latency. There's a general checks and balances question, reconciliation rather, that the IRS has. And as long as everything passes, you have those wages on file, they're reported, they have the original 941s, you're good to go. So 3 to 4 months turnaround time. And as of this last week, we've seen turnaround times as short as a month and a half. So again, they're getting better. Processing times are there. I still always tell everyone it could take up to 9 months to get your money, if not a little bit longer, depending on if your credits are over $200,000 per quarter. If you do have that threshold in terms of a singular quarter for over 200,000, I would expect for your credit to take closer to 9 to 12 months. But again, very important. It's not a question of if you're going to get paid, it's a question of when, as long as all the information that you have on file is accurate. Okay. So ERC versus PPP, we touched on this a little bit, so I'm going to be, pretty relatively brief here. Just want to talk about kind of some of the differences here. So with the ERC and PPP, for the PPP, you had an approval process, right? The middleman was your bank, okay? Obviously, with the retention tax credit, a bank is not involved at all whatsoever. It's you and the IRS. That's it. There's nothing more. So there's no middleman, and then more importantly, there's no approval process. If you have, so number one, if you're eligible for the credit, okay, you have prepared computations, you have original 941s on file with the IRS, and you send a 941X, which is just an amended tax return, an amended payroll tax return to the IRS, they're going to process your credit and they're going to generate your checks. It's not, oh, well, what happens if, we don't get approved, right? No approval process. As long as all the data that is submitted to us or that we pull is on file with the IRS, which it will be, as long as, you're using a payroll company, you have, you run a payroll, everything is good to go. And in terms of their checks and balances process, again, they're looking to make sure that you have that original payroll tax return on file, and that our computations that we provide to you, they actually make sense, right? So, if we claim a credit for, and I'm making these numbers up, $2 million, but your 941 only shows $100,000 in wages, obviously there's a problem, right? So they're looking at things of that nature, just very basic line items. They have a check off list. As long as everything aligns, it's going to get processed. In terms of denials, the only denials, which we've not seen a singular denial, by the way, just because there is no official denial. The only denials you would get are for those individuals who are perpetrating fraud, which obviously we're not anticipating for anyone on this webinar today, right? So denials are not in the realm of possibility, unless the information that's being provided is not fraudulent or is fraudulent and is not legitimate, right? Most businesses are also eligible. Almost every business really in America qualifies, because in some way, shape, or form, everyone was impacted by the pandemic. Obviously, there's some industries where businesses were able to pivot really well, mainly talking to the IT companies, right, where a lot of these folks could really overnight work from home. So teleworking, didn't have to come into the office, and didn't really kind of experience any disruptions. And if anything, they made more money, right? And just to kind of piggyback on that thought of making more money, even if you made more money during the pandemic, so in tax years 2020 and 2021, in comparison to 2019, but you were subjected to capacity restrictions, you still qualify for the credit. That's very important to understand, okay? And the reason being is because at that point, even though you didn't lose money, you technically did in a roundabout way, because it's, you had opportunity loss. If you weren't operating at 25% capacity, would you have had more individuals come into the store and spend money? Absolutely, right? So at that point, you're still able to tap into the credit, and we're, on that eligibility in terms of the criteria, that is the partial disruption. As long as you had that capacity restriction, even though you made more money, you could have made more money. So you had opportunity loss, right? Last tidbit on the differences between the ERC and PPP. The PPP had a dedicated amount of funding, X amount of dollars. The retention tax credit, it doesn't have a set amount of funding. It's not like once $10 billion is paid out, it ends, right? This is indefinite. So as long as the credit is still available, which it has that 3-year clock, as I hinted to earlier. So the Treasury will just keep printing. Again, it's a tax refund. There's no fixed bucket of funds or monies available that is dedicated to this particular credit. The Treasury will keep printing the checks so as long as you're eligible. So a couple differences in particular for using ERT credit. So number one, this is huge for many. So our process is really quick, painless, electronic, and simple, right? We typically have a turnaround time of 48 to 72 hours. If you have a lot more going on in terms of, a large number of locations, it could take, 96 hours, maybe a little bit more, but all in all, inside of a week, you're looking at, so put it this way, if you engage us Monday, you're going to have results by Friday, right? That's the general standard. The market right now, most turnaround times are 30 days, and that's if you're lucky, right? So we kind of have the competitive advantage when it comes to turnaround time. Simple pricing. So again, this is your money. Don't fall into the trap of believing that the IRS isn't going to pay. The IRS is going to pay. There's no need to pay 30% or whatever the case may be for individuals, trying to rush you into the process and get this money. None of that exists. Okay. And then lastly, maximum refund. So we've built, we have, several in-house algorithms, proprietary, obviously, that we've built, and a lot of these particular algorithms speed up the process with computing the actual credit. And then we also have an audit protocol that all the returns go through. It's a very rigorous protocol to ensure that nothing was missed, everything is accurate. And once we do the computations, we prepare the 941Xs, the amended returns. Those also go through an audit protocol, make sure everything is good to go there. And then again, we're not leaving a penny on the table. So, ERT credit, we're really known for not only our speed and our good pricing, but really maximizing this benefit and getting you literally every penny that you deserve. And at this point, we are going to answer any questions that you may have. And Cash is going to kind of take the reign here, share those questions that you've put in the chat today, and we'll kind of tango back and forth.
Yeah, thanks, Jordan. Appreciate that overview. We actually have several questions from the audience. I'm gonna run down the questions, and there are some questions that I'm gonna ask Liz too. Those are important ones because they speak to the client, what many of our clients feel as they go through the process. So if first question is from Allison, if your business is still operating, what are the taxes due on the tax credit?
That's a lovely question. So not to get really technical on you, but this is how the taxability of the retention tax credit works, right? And I'm going to give an example and use round numbers, and this is kind of the way it goes. So let's say basically what you're doing is you're reducing your deductible payroll tax wages by the amount of the credit. Okay, so if there's $1 million in payroll wages, then and your credit is $500,000, you're going to reduce the deductible wages by the amount of the credit. So then you would have an additional $500,000 in liability. Okay, for cannabis industries, those folks that obviously can't write off anything at all whatsoever, it's just straight up tax liability, and there's nothing that you can do about it. However, let's say your credit's $1 million and you're taxed at, say, 40%, you still cleared $600,000, right? So, and we've done a statistical test on this. 100 times out of 100 times, the retention tax credit is worth it. Even if you're at the highest particular tax bracket, you're still going to make out with money, no matter which way everything shakes out. Good question.
Thanks, Jordan. Second question from Madeline. I was told by Alliant Group that ERC money is not available for the cannabis industry due to 280E. Excuse me. How are you navigating that compared to others trying to provide the same services?
Yeah, that's a great question. So as referenced earlier, when it comes to the retention tax credit, the retention tax credit is not a traditional tax credit. So it's not something that reduces your tax liability, right, as a traditional tax credit would. It's a refund effectively on payroll taxes. More specifically, you get a refund on the employer share of Social Security tax for quarters 2, 3, 4, and then of 2020, and 1, 2 of 2021, and then any surplus that's calculated in terms of the computation would be refunded directly from the IRS. Okay, quarter 3 of 2021, folks, instead of taking a credit against the employer share of Social Security tax, the IRS has instructed employers, tax preparers, whatever the case may be, to take the credits against the employer share of Medicare for that particular quarter. And if you're an RSB, also known as a recovery startup business, those folks that operated or opened their doors or began business rather on February 15th of 2020 or after, you would be an RSB, or again, a recovery startup business. For quarters 3 and 4, you would take the credit, the employee retention tax credit first against the employer share of Medicare. And then again, any surplus that's generated would be refunded in the form of a live check from the IRS. So 280E, it's like I said, many are fearful. Alliant Group in particular is an interesting company to reference about the credits. And I can't speak to what Alliant Group does, obviously, but I can tell you, just because we work with dozens of accounting firms in states all over the country, this is something that many folks are actively taking advantage of, and very, very clear guidance. And I believe the IRS has even come out in one of the calls and have indicated a tidbit about the retention tax credit as it pertains to the cannabis industry, which at the conclusion of this webinar, I'll do a little deep dive and see if I can find the publication that actually references that, or at least the IRS call that does. But it's quite clear at this point that, again, payroll taxes are in a completely different section of the code, and 280E does not apply to the ERC. Good question.
Awesome. Thanks, Jordan. So this one's from Carrie. Does this apply to cultivation facilities also?
Yeah, so it does apply to cultivation facilities, but with the cultivation facilities, since you're not necessarily impacted by capacity restrictions, which is what a lot of our dispensaries are impacted by, we would look at, the two other ways to qualify. So number one, first and foremost, and the easiest is going to be the gross receipts test. So we're looking for that 50% decline in the, we're looking for a 50% decline in a particular quarter in 2020 in comparison to that same quarter in 2019. If you meet that, then for that particular quarter in question, you're eligible. And then again, for 2021, instead of 50%, it went down to 20%. And then we look at that particular quarter in 2021 compared to the quarter in 2019. If you had that 20% decline, you're eligible, okay? And then again, for capacity, that wouldn't be a thing since it's consumer facing. Those individuals that actually come into the business with cultivation, that wouldn't be a thing. So that particular criteria is out. And then lastly, number three, we would look to see what kind of supply chain disruptions you had. So again, and I'm just, giving a pure example, for one of your products, you weren't able to source, that particular product for whatever reason, or some of the components that make up that product, and you had no substitute vendors, and that product made up at least 10% of your sales in 2019, we could get you eligibility for the duration of time in which you were not able to find a substitute, okay? So as long as that product made up at least 10% of your sales in 2019. So again, with the supply chain disruptions, there's a lot of technicalities, a lot of gray area, which we steer clear from. We're going to look and have to kind of dissect on a case-by-case basis exactly what happened to your enterprise or what disruptions your enterprise suffered from, and then, go line by line and see if we're able to draw that line to eligibility for it. So to answer your question, gross receipts test and supply chain disruptions, that's what we would be looking at for you in particular. And happy to have a conversation. The worst thing that we can do is not try. So let's at least try, right? You could have several $100,000 on the table. So good question.
Awesome. And Jordan, I'm going to give you a break on this next one and hit up Liz.
Okay, very good.
Liz, there's a question from the audience. What if we apply and don't receive our money, or we are denied the credit? I remember having some of the earlier conversations with you before you engaged us, and this was a pretty real concern for you.
Yeah.
Yeah. So.
Well, I think it is for everyone who's hiring a consultant up front to, process something for you. And as Jordan said, do this. It's not a matter of if, it's just when. So I found that to be true in my personal experience, and then everyone else that we connected with over the past almost year, all the other local restaurants, lumber, distilleries, etc. Everyone got their credit, and they all got their checks in the mail at different times, different processing times, but at the end of the day, they all still came.
Awesome. And as I recall, Liz, you paid us before you got your money from the IRS.
I did, yeah. Yeah, I did.
So that was a little extra anxiety, I think.
Well, since we live in the same town, our kids go to school together, I felt okay about it.
Understood. Yeah. Unfortunately, the folks on the call don't have that privilege of coming to wring my neck.
I know. I do.
Yeah. Okay. So here's another good one, because I think I don't know if your accountant told you don't qualify, but I know you've talked to a few people, other people whose accountants told them they don't qualify.
Yeah, my accountant told me I qualified, but I had to do it through my payroll company, and that he didn't do that. And then I was using ADP as my payroll company. At the time, they were not helpful. I couldn't get anyone on the phone. I had talked to a number of other restaurant owners who had done the credit themselves, but I just couldn't figure it out. And then that's when you told me you could do it for me.
Yeah, that's a good point. Jordan and I never tell you can't do it on your own. We can tell you that based on just a general statistical test, we typically return about 40 to 50% more, a higher return. Again, this is about, Jordan talked a lot about this in terms of getting all of the money off the table. We've seen that consistently, that if you don't have a lot of experience with this credit, typically a lot of money gets left on the table.
Also, I've known restaurant owners who have done the credit with their bookkeepers and whatnot, and something was done incorrectly, and they've had to, pay the IRS money back. What this doesn't apply to cannabis, but it does in restaurants, is that if your PPP money, you can't double dip, right? It was one or the other. So I think some restaurants and some businesses ran into some trouble in that area, which thankfully that's not happened to me.
Okay, the next question is it's a little less of a question. Madeline, thank you again for this one. Possible to get a PDF of how to navigate the 280E concerns. We ran through too fast for me to take complete notes. I know we do pump a lot of data your way. Madeline, we'll reach back out to you and the rest of the group with some additional information around 280E. I think we can address that. Jordan, anything else to add on that one?
Yeah, that's totally fine. As I kind of hinted to earlier, suggested, I believe there was an IRS call. I read somewhere on a publication from the IRS that they referenced cannabis and hemp as a collective for whatever reason, and kind of dove into the 280E briefly. But I will most definitely take a peek, and we'll provide some documentation, hopefully directly from the IRS, that explains 280E as best as we can get them to explain it. Right? The IRS, they like using one-liners for something that really needs a book, right? So we'll definitely be able to pony up something and get that over to you.
Awesome. Hey, so there's two additional questions from other attendees, but I'm going to switch over. Allison actually has another interesting question for you, Jordan.
Okay.
So if you went out of business before or soon after getting the tax credit, you would not have any or minimal tax impact from taking this tax credit?
If you went on, yeah. So that's a good question, and that's interesting. So I guess it just depends on when you went out of business, right? Yeah, it depends on when you went out of business. But even if you went out of business, you're going to have that particular credit. Let's say it's $200,000-$400,000. There's no write-off against it. You're going to have tax liability. So maybe I'm answering your question right, but the point I want to get across is the credit in itself, especially if you fall under 280E in terms of your particular enterprise, and you have no deductions, obviously, that you can take or credits even if you wanted to, the employee retention tax credit at that point is, again, fully taxable. So you're going to have tax liability. And then I'm just going to mention this as well, just to kind of hit this from two different angles. Let's say that your business, you went out of business in, call it July 1st of 2020, right? If you had credit depending on your state, the earliest you could have had it from started is March 13th of 2020. If you had eligible wages or qualified wages from March 13th through June 30th, prior to your closing date on July 1st, those qualified wages you can most definitely tap into. Granted, you're eligible. Like when you're operating, you had to, again, reduce your capacity. You met the gross receipts test, or you had a supply chain disruption. So yeah, even if you closed down and shuttered, and the business is closed right now, for example, you can most definitely go back retroactively and claim the credit. Absolutely, yeah.
Yeah, let me just say that I did sell my restaurant September 1st. This time last year is when I handed over the keys, and I did claim the credit for those quarters, and I did get paid for them. And then the accountant has to, adjust the return for 2020 and then 2021 to show that income, which he was able to do. So selling the business, as long as, you had the business during the eligible quarters, you still get your money.
Yep. Thanks for that.
Yeah, thanks.
So do you have to spend the money on my payroll, or can I use it towards my other business expenses? Any other restrictions?
I love it. That's a great question. One that I was surprised didn't come up, so I'm glad it came up. So, and I always reference the PPP just because it was a direct competitor with the retention tax credit. So unlike the PPP, where you had to spend at least 60% on payroll and the other 40% on utilities, interest on mortgage, rent, supplier costs, cover costs, things of that nature. With the retention tax credit, it is pure income with no restrictions. So as I like to joke, if you get $1 million and you want to go buy a new Mercedes, have at it. You want to go buy a boat, have at it. You want to reinvest it all into the business, have at it. There's no restrictions in terms of the refund in itself. You can spend it on whatever you want. No restrictions across the board. As long as the money is recorded on your tax return and it's taxed, you're free to do whatever you want with the money. Great question.
And then we have another one, and this is a good one as well. So is this a credit for my company towards next year, or do I get an actual check like a refund?
Yeah, great question. So no, this isn't a traditional tax credit. If it was, you would be in trouble with, the IRC 280E, and we wouldn't be talking right now. So no, it's not a traditional tax credit, or even to be looked at like depreciation where it flows over to the next year. It's not like that. This is an actual cash refund. And when I say cash refund, a live check or potentially multiple live checks, depending on how many quarters you qualify for, that you'll get back from the IRS. So these are live checks only. There's no direct deposit. There's no tax credit that flows over to next year. Granted we engage, we'd retroactively go back for tax years 2020 and 2021 where you're eligible. And once we, complete those computations, send in those amended returns, IRS, in particular, the U.S. Department of Treasury, will issue those checks out, and they'll come to your place of business or whatever address is on your payroll tax return, also known as your 941. So live checks. Good question.
Yeah, I'll just jump in and say that, from the business owner standpoint, you file your 941X and then you wait and you don't hear anything. And then all of a sudden you receive letters for each quarter that you qualified for that tells you how much you should be expecting to get. And then about a week later from receiving those letters, and you'll receive one per quarter, you get one check per quarter. That is your refund to your amended return. And it is a check and it is written to the business. And, you do want to make sure it's coming to the right address.
Yes, good one.
We have a few of those. Oh, yeah.
That's right. We do a pretty good job of checking, but we also tell our clients to check when they receive the 941s. A lot of times they've either changed their business address or moved or shut it down. You want to definitely make sure that that last tidbit before it goes to the IRS is accurate.
Mm-hmm.
Okay. With that, I think we've gone through all of the questions. We can stay. We're already over time. We can stay and answer a few more if there are. If not, we are available at the phone number on the screen as well as the email address. We try to be very, very responsive. One of the things to note is that if you can't, it's not your job to figure out whether you're eligible or not. If you engage a company like us, we will do all of that work for you. You do not actually, the way we operate, I don't know about all the other ones out there. Let's say you engage us and you don't have a credit coming, or you don't qualify for whatever reason. Jordan's team basically does a really solid job of being very conservative on the eligibility side, because the number one way we can get sideways with the IRS with this credit is filing it when you're not eligible. We just won't do that as a company, period. But let's say we go down the road, as Jordan said, worst thing is to not try. We go down the road of doing the eligibility determination, and we determine that you are not qualified. When you engage us, just an important note here, you would owe us no fees. We charge nothing unless you are fully qualified, you're eligible, you're getting a refund, and you actually take final delivery of the 941s and the documentation package. It's only then that we believe a client should pay any fees, not until then, because there's no point in paying fees on a credit if you don't know if you qualify and you don't know if you're getting any money. That's kind of a not a good place from our perspective for a client to be. So.
Fantastic. Well, thank you so much, Cash, Jordan, and Elizabeth, for really diving really deep and in depth into some of the nuances of this credit and how it can really be applied and both maximized for cannabis business owners in particular. Before we close it out, I know that we did dive a little bit deep, but did Jordan or Elizabeth, did you have a final thought for all the audience members to take away from today's conversation, or is it as simple as reach out for more info and get the ball rolling on your credit process for your cannabis business?
Well, I
Yeah,
think,
go ahead, Liz.
sorry, I think the best way to see, is to get a quote from Cash and Jordan and see what your eligibility is instead of, trying to figure it out on your own. Just see what they can get for you. It's not too hard.
Yeah, that's a good thought from Liz, and exactly what I was going to say. Definitely reach out. We're happy to hear exactly what you have going on. Take a peek at your enterprise or your locations, whatever you may have, and see if you're actually eligible for the credit. Again, there's nothing, no kind of fee or anything of that nature to determine eligibility, and we're happy to take a look at your situation and see if we can draw that straight line to eligibility. If we can, forecast out a credit and tango back and forth, formally engage, and we'll get the show on the road, right? So my final thought that I just would like to leave with everyone is, listen, there's a lot of money on the table here, money that's rightfully owed to you. So take advantage of it while it's still here. And there's many possibilities. And just to kind of jump onto the thoughts of one of the last questions that I answered in terms of what you can spend the money on. I mean, use this as an opportunity to not only take care of yourself, right? Just as an owner or owners, but expand your business. Do a remodel that you've been wanting to do. Dip your toes into something else. Get additional equipment, whatever the case may be. So take advantage, and we'd love to hear from you.
What's the deadline again?
There's
All
one
right,
more question, Jordan. What's the deadline? Can you just go over that again, please?
Yeah, absolutely. So the deadline, you have a 3-year window starting first quarter, the end of first quarter of 2020. So that's going to be, call it April 1st. And then July of next year, so 2023, is when you start losing eligibility quarter to quarter. So in order to get the full credit, granted you're eligible for the full credit, you're going to need to do this obviously sooner than later, right? Definitely no later than June of next year. Don't recommend waiting that long for obvious reasons, but you do have a little bit of time. It's not like you need to pony up and get everything together by tomorrow, or you're going to lose it. You have a little bit of time, but definitely take advantage, sooner than later. You don't want to wait to the last second. The IRS doesn't get your 941X. They can't find it. They claim it's out of the, period in which you can apply for it. You just lost $100,000 to $300,000, right? Not a good feeling, and not a feeling I want anyone, at all, especially those folks on the webinar today, to have to feel. So good question.
Perfect. Well, thank you so much, Josephina, for that last question. I'm sure that was at the top of a few people's heads as well before we closed out the program. So fantastic. Thank you so much, Jordan and Elizabeth, for providing that final thought and that key takeaway for all the audience members to leave today's program with. And thank you, Cash, for really moderating and spearheading and leading the conversation from development through execution today. Really a great pleasure working with you and the rest of the team to promote this amazing opportunity to our network. Our panelists are going to leave the virtual stage, so let's give them one last round of applause in the chat room. Post your appreciation messages. If you have any questions, like I said, they're going to be off stage for the next 3 to 4 minutes, but they will be still here and able to interact with you directly inside of the chat room. If you have a question that you didn't want to ask publicly, you can also use that recipient field in the chat window to direct a direct message to either Cash, Jordan, or Elizabeth. And again, as we've mentioned throughout the program, everyone will be provided with both a PDF of today's presentation slide deck, as well as a formatted video recording of today's session sent directly to your all's email inbox within 48 to 72 hours after the event. If you are interested in rewatching or sharing today's program immediately with any colleagues, coworkers, or your boss, in order to get this process pushed along, feel free to direct them or yourself right back to the Facebook Live, where we've been doing the live stream to coincide with today's broadcast. All right. And with that, thank you all so much for participating in another NCIA Industry Essentials educational webinar. Feels really great to be back here in the swing of things, engaging with our network in a live format. So we sincerely hope that you all will continue your participation with all these interactive educational opportunities into the fall and winter. You can head to the events section of NCIA's website following today's broadcast to secure your spot in all of those upcoming virtual and in-person events, of which we just outlined a number of events taking place across October that we'd love your participation with. If you haven't yet, make sure that you are, most importantly, signed up for our Events Digest newsletter that goes out every Monday afternoon. That's really going to keep you up to speed on all of our activities as soon as they're announced, as well as provide supplemental resources to make the most out of your involvement with these educational sessions. All right, huge thank you once again to the members of our panel from ERT Credit for presenting today's session, along with all of our audience members for sticking around even after the allotted hour in today's program and really engaging with the interactive elements of today's session by diving into the Q&A. As always, we'll leave you all with this end of event credit sequence highlighting the 75 plus member businesses that joined us across 2 days earlier this month in DC for our 10th annual Cannabis Industry Lobby Days. If you don't see your company listed here, head to NCIA's website to learn more about the 2023 edition of our annual Lobby Days for the cannabis industry and learn how you can really support our mission and move it forward on Capitol Hill. With that, enjoy, and we'll hopefully see you all again tomorrow for the next NCIA Industry Essentials educational webinar being presented by our State Regulations Committee, and focusing on all of the amazing ballot initiatives that are up for a vote in this upcoming election. Thank you all so much. We'll hope to see you then. Have a good one.